Good morning. You're watching a live market outlook for Friday, 27th of January 2012, prepared by Windsor Brokers. End of the week and end of the month of January that showed different sentiment from an extremely negative tone, especially for the euro at the beginning of the month, and then from the mid-January, strong recovery of the euro and the US currency falling across the board. That was actually accelerated in a few days ago by Fed's decision to extend its ultra-low rates for a extended time of period, most probably towards year 2014. Also focus remains on Greece and some positive news that are coming and hints of possibly finding the agreement with the private creditors keeps the positive short-term tone for the single currency as it's rallying in past 2 weeks from its low at 126.22 and regaining levels above 130 and looking for test of our next key barrier at 132. More of this will come in the technical part. Back to Greece, as the Greece and its private creditors made progress yesterday in talks on restructuring its debt, as both sides confirmed, and they will continue negotiations today with the aim of sealing an agreement within the coming few days. Athens needs a deal quickly to avert the chaotic default when a major bond redemption comes due in March. Greece's creditors are demanding that European Central Bank contribute to a deal to put the country's messy finances back on track. The Institute of International Finance, which leads talks on behalf of creditors, similarly said the progress and work will continue today, but neither side disclosed any details for now. After weeks of wrangling over the coupon of interest rate, Greece must pay on new bonds it will swap for existing debt. Attention has shifted to whether the ECB and the other public creditors will follow private bondholders in swallowing losses. A day after International Monetary Fund Chief Christine Lagarde said the ECB might need to accept losses on its Greek holdings, European Union's top economic officials also warned more public money will be needed to make up a shortfall in the country's second bailout. We'll be watching closely today's developments in the negotiations between Greece and its private investors, as this is one of the burning problems for not only for Eurozone but threatening to affect the worldwide world economies in case of the worst scenario, the default. Currencies were on the reversal from yesterday. Euro is holding around the 131 level after yesterday's failure to regain our next strong barrier at 132.00, but holds the positive tone as immediate supports just under 131 held the dips for now. Dollar yen is back down to the levels below 77 as unable to clear the strong barrier that was reached and tested yesterday and day before at 78.20-30 zone, and the risk is back to the downside with the intervention rumors circulating again, most likely at 76.50. This is the critical support and the strong medium-term support that held the dips of dollar yen in past 3 months from mid of January when it was tested first time. The dollar also continues to trend lower against the Swiss franc, raising for now about 38.2% of the latest rally from 85.66. However, the wider picture of dollar Swiss is now weakening. The structure is weakening as broader rally from 70.67 record low is now under threat as the upside remains capped at 96, and the further weakness of the US dollar might trigger a stronger reversal of the dollar Swiss. From commodities, gold remains steady as it reversed from the recent highs posted yesterday, as speculators were booking their profits on the latest past few days. Strong rally, but positive sentiment remains on gold, and the further upside extension towards our next targets at 1756 and 64 is still intact, as long as support at 1700 and 1660 holds the downside. All of this also we'll have in our technical part. Briefly from the World Economic Forum in Davos that is entering the third day today. Some important headlines: that some of world top bankers are increasingly hopeful that Eurozone debt crisis can be resolved, and confident of a deal to ensure Greece's now inevitable debt default will be orderly. Participants at the private meeting in Davos, which included CEO from JP Morgan, Barclays, Citigroup and UBS, acknowledged that had been significant progress. Most pointed to the European Central Bank launching last month of €500 billion in cheap 3-year loans as a possible turning point after almost 3 years of market chaos that threatened some of the sector's biggest players. But bankers also praised the progress made in pushing towards the Eurozone fiscal union and on solving the European banks' funding and liquidity problems through cheap central bank money. Also, the German Chancellor Angela Merkel deflected pressure on Wednesday to increase the Eurozone's rescue fund, saying the key to reassuring markets was to restore lost trust in the government's policies. She also said closer European integration would eventually bring a solution to the 17-nation currency area debt crisis. Delivering the keynote address to the annual World Economic Forum meeting in Davos, Merkel questioned the rationale of those in financial markets, governments and the IMF who were pressing Berlin to put more money on the table, but did not rule it out. IMF Director Christine Lagarde called in Berlin this week for 17-nation currency bloc financial firewall to be effectively doubled by combining a temporary and permanent rescue fund to reach €1 trillion. EU officials also said they expect Berlin to agree in March to let the existing European Financial Stability Facility, EFSF, which still has about €250 billion in uncommitted funds, and the future €500 billion IFSF European Stability Mechanism to run in parallel. Angela Merkel did not comment on that idea, but said Europe had to work to rebuild the market trust through stricter enforcement of more binding fiscal rules and reforms to make their economies more competitive. From today's events, brief look at the calendar for Friday, 27th of December, starting with Japan. That's some events already came out. Tokyo core CPI came more worse than expected, minus 0.4% compared to minus 0.3% forecast and previous release, while Japanese national core CPI on the yearly basis came as expected at the minus 0.1 compared to minus 0.2 previous month release. China remains closed for the Lunar New Year today again. German import prices monthly release came out already. According to forecast, 0.3% was the release compared to 0.4% previous month release. At 9 o'clock GMT, M3 money supply for Eurozone, 2.2% increase is forecasted for today compared to 2% of the previous month release, while private loans are expected to grow by 2.1% compared to 1.7% of the previous month release. From Switzerland, the COF economic barometer is due at 10:30 GMT, and minus 0.6 is today's forecast compared to plus minus 0.06 is today's forecast compared to plus 0.01 previous month release. ECB President Draghi is due to speak at 13:30 GMT, and then batch of data from US starting at 13:30. US advanced quarterly GDP forecast quite positive for today. 3% is consensus versus 1.8% of the previous month release, while advanced GDP price index quarterly is forecasted at 2% compared to 2.6% previous month. University of Michigan consumer sentiment is due at 14:55 GMT, and slight improvement is forecasted for today, 74.2 compared to 74 of the previous month release. That would be all for today's events. Now we're going to take a look on the technicals for in past 24 hours and today's outlook. Euro is in stable uptrend from 126.22 low of 13th of January, as the pair cleared some very significant barriers at 130.75, 131, extending gains also through 131.30. 55 days moving average seen on the daily chart, also clearing a strong support low of 4th of October at 131.45. However, failing to regain the next significant barrier at 132 zone. We have a high of 21st of December 2011 at 131.96, and the low of 25th of November 2011 at 132.11. That was our initial target. And above this, it's also the 38.2 Fibonacci retracement of down move from 142.46 to 126.33 at 132.36. The market fell short of these levels, hitting 131.83 so far, with subsequent pullback briefly under 131 mark, finding support for now at 130.76. This is the previous high and strong resistance, with the pair so far holding here. However, negative hourly studies are turning negative at this point, and as long as 20 days moving average currently at 131.16 maintains this near-term downtrend, the risk remains for further extension lower and the possible test of 130. Where dips should reverse ideally to maintain the current strong uptrend, short-term uptrend. 130, 129.84, the previous high, and this is expected to contain dips in case of further extension lower. However, key support stays at 129. At 129, 128.70, 129.30, and 128.75. The break point is at 128.75, and this is also below 50% of Fibonacci retracement of the entire uptrend. And the loss of this level would put aside the short-term bulls and open way for further weakness. For now, the pullback is seen corrective, and the upside momentum on the short-term structure is still strong, and the possibility of retest of 132 zone is quite likely. Also important to mention, end of the week might mean also the clearing of position and taking profit on the exactly 2 weeks long, so that might trigger further easing on the euro-dollar. As usual, most of investors are trying to clear their positions by the end of the week and to start with the new ones at the beginning of the next week. So there is still risk of further easing of the euro-dollar, but while 129.30 I would say at this point holds, the upside will still remain in focus, but ideally reversal above 130, 129. 85 would be ideal for the resumption of the short-term uptrend. The British pound also in a steady uptrend from 13th of January low at 152.33. Important levels that were cleared at 56, 60, 70 zone. The previous high and high of previous high of 2012 posted on 3rd of January at 156.68. Initially, it cleared the 155. 80, the 55 days moving average, but strong barrier was at 156. 60, 70, where the pair cleared the 90 days moving average and the main bear trend line drawn of 166.17, 19th of August 2011 high, extending gains through 157 figure resistance, just ahead of critical barrier at 157.70 zone. This is the ceiling of the end of November to end of December range that kept the upside capped for whole month ahead of the subsequent easing that ended in breaking some important supports at 156.30 and 156.00 that were marking the range low and extending so far to 152.33. We need to see the sustained break above 157 for a retest of this critical point, above which to open way for a fresh phase higher as the pair is still within the range of the November-December at around 154 to 157.70. This will also greatly improve the structure of the cable on the longer term outlook, as the studies are breaking above their center lines, and the daily outlook remains now more positive and keeps the upside favored. On the short term, temporary support overnight was found at 156.60, which is around the previous high at 156.68, along with the dynamic support of 20 days moving average currently at 156.34 that maintains bulls in past also almost 2 weeks. Leaving a higher low, at this level keeps the focus higher as the pair regains 157 as initial barrier, with clearance of 157.33 to open way towards our critical barrier at 157.70. Next supports are at 155.30, very strong support, and the critical one at 155.00. Previous highs of the 10th of January. Loss of this level would definitely dampen the short-term bulls and open fresh bear face, and will keep the upside intact for the short term. Dollar yen is back to weakness after past 3 days. Strong rally and trip to critical resistance on the longer term at 78.20-30 zone that was tested but failed to break higher, as 200 days moving average at 70.31 currently kept the upside limited. The pair has completely erased the latest rally from 76.85 after losing initial support at 76.60. This was broken main bear trend line, broken main bear trend line drawn of 124.14 2007 high, and it weakened the short-term structure with the overnight's loss of 77 initial support hitting 76.88 so far, just ahead of our initial support, where the up move started at 76.85. And hourly and the 4-hour studies are now pointing lower and in negative territory and keep the downside favored, as hourly 20 days moving average currently at 77.20-35 maintains the past 2 days bears and keeps the focus at the downside. 76.85, 76.65 and 76.85, 75 and the 65 are our next targets, ahead of a very strong support at 76.50 zone, the low of mid of November, and the low of beginning of January that contains for nearly 3 months the downside. Some rumors of possible intervention are seen on the loss of are actual again back to to the treadmill, as this level was a couple of days ago also mentioned as the critical for the Bank of Japan to intervene. So the rumors are back, and we will keep an eye on the dollar yen in case of further weakness, as the short-term studies are pointing lower, and we'll look for possible action of the Central Bank of Japan in case of attempt at through 76.50 or critical medium-term support. The dollar Swiss near-term price action shows some recovery attempt after extending losses to 91.54. Loss of our initial supports at 92.00 Fibonacci retracement 38.2%, and 90 days moving average currently at 91.78 is further weakening the structure and threatening for further extension lower to test the next level at 91 as a figure support and 90.75 50% Fibonacci retracement. Also the static support at that zone stands at 90.64. It's the 30th of November 2011 low. The hourly, the daily structure is weakening now. As we can see, the studies are breaking below their center lines, and the critical levels already taken out. So we might see further easing of the broader uptrend from 70.67 to 95.93, with the previously mentioned levels to come in focus. Recovery attempts are now underway. The pair is struggling currently at 92.20 zone. However, regain of minimum 92.33.50 and possibly 93 is required to signal some stronger recovery, but break above 93.38 high of 25th of November, and also significant lower top at 93.76 high of 23rd of January is required to avert immediate downside risk and allow for a fresh recovery and possible attempt at 94.00. For now, 92.50, 93.00 keeps the upside capped, as 20 days moving average on the 24-hour chart is that maintains the bearish structure from 95 after losing 95 support, keeps the upside limited for now. A brief look at the commodities also, very significant for gold that surged through the daily Ichimoku cloud. That confirms the positive short-term structure of 1522 low of 29th of December, break above 55 90 days moving average and the main bear trend line of 1920. Also regain of our initial barrier at $1,700 that was mentioned in past in previous few sessions, has so far seen 1730 posted yesterday, with the currently mild correction and consolidation around this level. The studies are supportive, however, still overbought conditions on 4 and on 4-hour chart. See scope for some further corrective action, with the 1700 level expected to contain for now, ahead of 1692, whereas the 20 days moving average that now maintains the latest strong rally of the gold. Short-term focus remains now at, as the pair retraced over 50% of the initial down move from 1920 to 1522. Immediate focus is at our highs at 1756 and 1763, ahead of Fibonacci 61.8% at 1767. On the downside, the strong support as mentioned at 1700, 1690, while break below the broken trend line approximately at 1670 zone would put on hold immediate bulls and look for the further easing. Critical would be loss of 200 days moving average at 1645 currently, that might signal false break above the trend line and risk a lower top ahead of further extension to the downside. The crude oil is near-term price action is again in defense after hitting a fresh high yesterday at 101.37, correcting the latest rally. Attempt through the initial support at through initial support at $100 first, and then 99.40.50. Sees risk of further easing as although the 20 days moving average for now holds the downside. It's important that the oil price will not break significantly below this level, with the reversal around this area seen ideally for a fresh push higher, as the 4-hour studies are still in the positive mode and breaking above their midlines and pointing still higher. A regain of 100 to open next significant level of 101.37. However, broader downtrend from 103.72 continues to pressure the downside as the oil price holds above 102 zone, which is currently the main bear trend line, and only break here and the previous highs at 102.22 zone would signal double bottom at 97.43.53 and a fresh recovery towards level above $103 per barrel.